Hi guys, welcome back to Model Pro. I've been researching various topics to provide tutorials on, and I've noticed that a lot of existing tutorials and articles explaining how to construct cash flow statements are really overly complicated. So I wanted to take this opportunity to explain how to construct a cash flow statement using the existing statements that are available to you. In this case, the income statement and the balance sheet. For those of you who aren't familiar with the term income statement, it's just another name for profit and loss statement, depending on your reporting jurisdiction. So I'm going to go through the process of constructing a cash flow statement step by step. I'm not going to introduce any numbers from other sources or other reports. I'm just going to use the numbers on screen and do my calculations using the figures on screen in these two reports. I've already set up the framework of the cash flow statement. So it's split up into operating cash flows, investing cash flows, and financing cash flows, and then just the reconciliation at the end. That is the typical breakdown of a cash flow statement you'll see in today's accounting financial statements. I've also included error checks to the side here, just to give you peace of mind that the numbers I'm presenting have some integrity. So the opening balance sheet balances, the closing balance sheet balances, and the movement in the P&L reconciles with movement in equity from year to year. So you can have some faith that what we're working from is reasonably sound. You should also do the same when you're constructing your cash flow statement. Make sure that you can rely on the numbers. Obviously, I have a check here that's throwing out an error. And that is basically, this is the cash at the end of the period. I want to make sure that the cash flow statement that I present produces a cash balance that reconciles with our closing cash at the end of the year, which is 30 June XX. In this case, just assume whatever year you'd like. So 2018, 2019, I've just assumed XX. So the cash number we should have here is $229,811. We need to get to that number, and I've just constructed a simple error check that ensures that what we're presenting is correct and that all the numbers reconcile. So let's jump into the calculations. Now, the first step in reconciling or calculating cash flow from operating activities is to start with the NPAT, the net profit after tax. So we have an NPAT figure here, 476,000, but remember that that's a non-cash figure. That represents the reported accounting profit for the year. It doesn't necessarily represent cash movements. So we have to make adjustments to the non-cash profit figure in order to get the cash profit figure or the cash operating cash flow. There's two general sets of adjustments I like to work with. I call them working capital adjustments. There are other names for them, but basically they are the movements in your three key current asset categories. So the movement in receivables, your trade receivables or your accounts receivable, your movement in inventory, stock, and your movement in trade payables or just payables for the sake of this tutorial. And they are reasonably simple calculation. Basically, we just have to calculate the year-on-year movement for these three categories. Just a word of caution, I'm just going to do these three calculations now, and we have to make some adjustments after the fact. So just bear with me. Oops, sorry. That should be inventory, and this should be payables. So as you can see, I'm just calculating the current year minus the prior year figure to get the movement for the period. Now, I'm not done yet. Taken the non-cash profit here, and we have to have a serious think about how each of these items impact that profit figure. So there were 241,000 increase in accounts receivable. How does that impact the cash figure? So if we're not receiving accounts receivable, we're not getting the cash. So in that case, it's a negative adjustment to the profit figure. I just want to repeat that, just so it makes sense. If you haven't received or reduced your accounts receivables, it means that you haven't received the cash. That is therefore a negative adjustment to your cash figure or your operating profit figure in cash terms for the year. If the accounts receivable reduced, that would mean that you had converted those receivables into cash, and therefore this would be a positive adjustment. You just need to be mindful of that when you're doing these calculations. Think about logically the impact on the operating profit figure and how it converts to a cash figure. Same with inventory. Inventory increased year on year. Therefore, we potentially spent more on the inventory balance. We purchased more stock. That in cash terms means it's a negative adjustment to stock. Payables was an increase, and that means because we didn't pay back all our trade payables, we increased our cash balance. We held out cash and we didn't pay it to our payables, so therefore it's an increase on our operating profit figure. That is our working capital adjustments. Those are all of our working capital adjustments. And there are another round of adjustments I would like to make, or other adjustments, and they are for the cash impacts on non-cash accounts. So depreciation is the big one. Depreciation, as you can see, is circa $210,000 loss on the P&L, but that's not a cash figure. So we need to add that back to our NPAT, because although our NPAT is saying we lost $210,000, in cash terms we didn't. So I have to add that back to the $476,000 we started with. Now we have to adjust for interest expense. Did we actually pay any interest expense during the year? I know we reported interest expense on our P&L, but the actual cash impact we need to take from the balance sheet. So the movement in interest payable year on year. So in this case, it's increased by that much. So we're already reporting interest expense in this figure here. Again, because it was an increase in the interest payable balance, it means we didn't pay it off, and it represents a cash increase. Same with tax. Did we actually pay any off? We have tax expense over here. It's reported as a P&L number, but it's not a cash figure. So we have to make adjustments to our cash from our cash balance. Again, and that is our operating cash flows for the period. The most complicated aspect of the cash flow statement. Very difficult, and I just need to emphasize that you need to think logically about each of those steps in the calculation. The next step is investing cash flow. So the purchase or sale of major assets, equipment, typically the biggest thing that we do here. Cash that we've invested could have been acquisition of other entities, partial acquisition of other entities, or acquisition of hard assets, fixed assets. In this case, it's fairly straightforward. We don't want to take the accumulated depreciation because that's an accounting figure. It's not a cash movement. The actual cash impact appears to be from the purchase of fixed assets. So we've had an increase in fixed assets during the period. Now, you can see a problem with that already because we're reflecting an increase in fixed assets, but as with the above figures, we want to make sure we account for the cash impact, which was a negative movement. So again, be conscious of the actual cash impact on the cash flow statement. Finally, financing cash flows. This is the section where we account for the manner in which we finance our balance sheet or our business. So things like bank debt, share movements, how we access or use our debt and equity to fund the business operations. Here I can see two items, bank debt. I notice that the shareholders' equity or the share capital has increased. So those would be the two big ones for financing. Why am I saying repayment? Because it looks like year on year the bank debt decreased. And the shareholders' equity increased. So fairly simple. Share issuance, it's a simple $70,000 increase, whereas the repayment of the bank debt means that we spent a certain amount of money to pay it down, and that is consistent with the cash movement. So a reduction in the bank debt means that we have a reduction in our cash. Okay, that's it for each section of the cash flow. Now let's see if we can actually get the balance at the end of the period to reconcile with our balance sheet. So we're going to have a net increase or decrease in cash for the period being the sum of these three figures. We've got a little bit of a decrease for the year. We're at cash at the beginning of the period, which is 294. There we have it. The cash at the end of the period reconciles with the cash on our balance sheet.